Canada paused their rates again. We are not shocked by this. This is exactly what I predicted was going to happen. This is a takeaway from all the other banks on earth who are continuing to raise their rates, but they're taking note of Canada. We're going to be doing a deep dive into this and how does it affect your pocketbook. My name is David Ruff. Thanks very much for coming by. I'm a broker in Toronto, Canada, and I specialize in properties in North America. And we're going to be diving into this today because I care about you and I want you to make a lot more money with your moves moving forward. Let's jump into the first article of the day. The Bank of Canada holds interest rates steady as it forecasts inflation to slow to 3% this year. Now, the central bank had telegraphed its intention to hold rates for now. Now, we knew this from last time. Now, the bank is forecasting inflation to be 3% by mid 2023 and return to 2% next year. I think that this is a little bit of a pipe dream, but let's continue on. The Bank of Canada has decided to hold its rate today and wait for rate hikes to filter down through the economy. Now, this is key, you guys. This is what we always are talking about. There is a lag effect. And the lag effect is how long and how much savings do people have in their banks. Remember, the first interest rate took place a year ago, 12 months ago, and it takes 18 months for the full effect of a rate hike to make effect. So we're not even at 18 months from the first rate hike. We have 8 of them in Canada, 9 of them in the United States. It takes 18 months after they've done it for you to actually feel the effects. And so let's just think of this as one person goes, okay? So one person has a mortgage rate of $4,000 a month, and then the mortgage rate almost goes way, way up. Now your mortgage payment is $6,000 a month. Imagine that. So you're not going to sell your house immediately. You're going to be, let's hang on and see what's going to happen. The majority of people do that. They're going to hang on and see what happens. So do they have an extra $2,000 a month? Not usually. Now they're going to be getting another job, which we see in the job reports, or using their savings, which we're seeing in the savings numbers. They're going down, 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 or they turn to credit card usage or lines of credit. And we see that nationally going up, 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 up. The writing is on the wall every time. 12 to 18 months later after the last rate hike for you to feel the effects. So this is why they keep talking about we're waiting for it to filter through the economy. Key words for everybody, me, you, everybody, that it takes that 12 to 18 months for you to actually feel it. We're not even close to that right now. We're in like inning 3. All right. So see right here, the rate hikes filtering through the economy. Now, they've raised them 8 times. We know that the United States have raised them 9 times. The data for March is set to be released next week, and it's expected to show the rate has cooled to 4%. Now, when you hear that the rate is going to drop, please remember, this does not mean things are getting cheaper. So just let's imagine that you were going to buy, let's say, a trailer, and it was $40,000 last year, and it went to $50,000 this year. That's a 25% increase up. Okay, but if the trailer stays at 50,000 from last year to this year, it has gone to zero inflation. It hasn't gotten cheaper. It just hasn't gone up anymore. So the relief for people would be that the prices come down, but that's not happening. Once the prices come up, they never go down. And it's usually because the government has printed a lot of money. All right, let's dive right back in to checking out other countries, you guys. If we check out Canada, we can see that Canadian inflation topped around 8%, and it's crumbling down now in response to the interest rate hikes. So those who you are listening on our podcast, as the interest rates go up, inflation comes down. But the reverse happens. As the interest rates drop, inflation goes up. And so imagine it's like a crocodile mouth opening and closing. The two actually work together and they come together. But we can see Canada's inflation now hitting around 6% is very close to the 4.5% that the rate is. Also in the United States, we can see aggressive 9 hikes in a row. And we can see as well that the inflation dropped from 9% all the way down to 6 again. And it's almost touching what inflation is. But the reason why we're looking at these charts is because in the United Kingdom, they're in a lot of serious trouble. We can see they did the same thing and dropped the rates. They were almost at zero anyway. But as they've been raising rates, it hasn't affected inflation at all. Also, Japan, they're not doing very good. France, Italy, it is having a big response, but it isn't even close to matching up yet. Where we want it is the interest rate at least to be where the mortgage rate, inflation rate is. Germany still has a wide gap. Australia has a wide gap. So yes, sure, I know what you're going to say is, well, Canada is doing good if we compare it to other countries. Sure, but we're still not doing good. Do you know what I mean? Prices are still going up. People are struggling to be able to pay for anything because they've printed so much money. So this is something that we have to pay attention to. Yes, we're better than most, but we're still not doing that great. Cooling and Bank of Canada has decided to sit on the sidelines for a while. Well, that's a good thing for us. Getting inflation down to 3% in the summer will be a welcome relief to Canadians. Again, it does not mean prices are going down. It just means that prices are not going up at fast of a rate, the same rate that we were experiencing in the past couple of years. All right, let's continue on. The bank left the door open for more rate hikes if necessary down the line. But overall, the policymakers, they have said that the rate changes can be paused for now. But this is very important. They are not saying that they have stopped raising rates. If they need to, they will continue to raise rates. All central banks are telling us the exact same thing right now. So that is very, very important too. Now, people are really having trouble for their mortgages. So people are up for renewals right now this year. This is the important part. People are going to be underwater by a lot. People are very, very, very worried that they're going to be not able to pay any of their mortgages because the prices keep going to the moon. Let me give you an example, you guys. If we take a typical mortgage, let's just say for a second, last year, the property was worth 1.5 million and you had a mortgage on it of 1.2 million, okay? 1.2. Right now, those properties are down about 25%. So let's just say for a second, for easy math, your property is now worth $1 million, right? But do you see the problem here? You owe $1.2 million on that property. And now the property is only worth $1 million. But on $1 million property, how much is the banks willing to lend you? The banks are willing to lend you $800,000. So how can they fix this? It's $1.2 million that you owe on the property today, but the max that the bank will lend you is $800,000. You are $400,000 short. $400K. What are you supposed to do about that? Where do you come up with the $400,000? And this is the poison pill that we're running into right now. So last year in 2021, if you look at the banks over 25 years, how many banks had an over 25-year mortgage policy? I can already tell you the percentage was 0%. So if we fast forward to today, where we are in 2023, and we're looking at mortgages over 25 years, do you know where we are today? We are at 30% of people are over 25 years. That means they have 35 and 40-year mortgages. So you're going to tell me right now, David, this is insane. How can this possibly be it? How can this possibly go to 40 years? Because you can't go to the bank and get a 35, 40-year mortgage. No, you cannot. Well, it's a good question, you guys. Let's look at that. So let's say that you had a mortgage in 2020 when you bought your home and you were going to refinance it in 2023. This is the end of your term. So for Americans in Canada, we don't have 30-year fixed mortgages. We amortize it for 25 years, which is the maximum, but we have to renegotiate it every 2 years, 3 years, 4 years, 5 years. We get to decide, but it's generally under 5 years. So let's just say that you chose a 3-year. This guy now, the example that we just saw, he's mentioning in 2023, we're going to have this problem. So let's just say that you were in this same position. Let's just say you ran into a problem in 2022. Sound familiar? Last year? You're still mid-cycle right now between these two spots. And in 2022, you go to your bank and you tell your bank, listen, guys, I can't afford the interest on my payments. The payments went from $3,000 to $5,000. I can't afford it. And the bank says, this is what we're going to do. Make your payments $4,000, but we're going to extend it to 35 years, to 40 years, just to be able to help you stay in the home. So remember where we are in the stream of time right here, guys. We are mid-cycle, right? So they can do that when they're mid-cycle. But if you hit the end here, at the end of your original contract, now you have to refinance that thing and you have to renegotiate with the bank in most cases. Of course, there's always caveats to it, but in most cases, you will have to do that. When that situation comes, you're going to be right back to this example that I gave you here, where they say, okay, you guys, you owed 1.2 on your home. Now we can only give you 800,000. You're upside down by 400K. And so this is where people are really afraid right now, because what on earth are they going to do? Where are they going to be able to get that extra money? I can already tell you the answer is they don't have the money. So if we look back at this poor gentleman here, he says the loan is up for renewal this summer, and this is where they don't know what is going to happen to them. Big trouble, you guys. But this is what we have to look at. Look at the Canadian 5-year bond rate. This is really important for everyone to pay attention to. I want you to go back and let's just look at 1 year. For every 1% change, home prices will move by 10%. So if we look right here at the peak up here, this was 3.6. This was in February. And then all of a sudden, the rates fell all the way down almost 1 full percentage, 1 full point. Remember, when the interest rate changes by 1%, your home adjusts by 10%. So if interest rates fall by 1%, your home goes up 10%. So you have to go to me, whoa, David, I don't get it. How on earth can interest rates go up and down at the same time? I get this question probably a dozen times a day. This is a very good question. Let's get into it because this is really important for you to understand. Let's go back to our screen and let me try to explain to you, you are paying 2 forms of interest rates. If we just paid attention to what we just saw on the charts, the interest rate for the Bank of Canada went like this 8 times, and now they've paused it. Are we correct? Yes, we are correct. And so right now it's sitting at 4.5% at the top. But do you get a mortgage at 4.5%? That's my question. The answer is absolutely no. You do not get it at 4.5. What you would do, you would see this is actually the mortgage rates that you have, and it's always like 1% over. This is the bank. And now the bank wants to charge you this 1% commission kind of thing that's over the rate that is the 4.5. They always want to do that. So this all in this purple here is the commission from the local banks. And it's generally, around 1% over what it is. So imagine here, it was 1%. But what happens if, let's say, a bank worth $200 billion in the United States called Silicon Valley Bank went bankrupt and they lost the Canadian banks $20 billion? What happens? All of a sudden, the banks are scared and they're like, hang on a second. We don't need 1% commission anymore. We're now willing to accept 0.5% commission. So now they've reduced their commission down here by 0.5% or more. So do you notice that you're paying 2 portions? You're paying the bank portion, Bank of Canada, and then you're paying the local bank, their commission, essentially, their profit to get you that. So 2 things can always happen at once. You can have the central bank of the country raising the interest rates, and you can have simultaneously your local bank reducing how much mortgage that they'll give you because their commissions are going down. Let's jump back into that bond rate because that bond rate is showing you the commissions that people want to take. You can see on this chart, this is how much commission that they want, and they're using this as to reflect your mortgage rates. So every time you see this drop, that's when you want to be selling your home. Prices are on their way up. If you see rates spiking and going up, that's when you want to be selling your house, right? You want to be selling it at the bottom. Up here is when you want to be buying it. So right now, when this dropped from its super uber high at the beginning of February, people have had this massive boom in the springtime because they love this, right? Home prices are going up and everyone says it's the spring market. It's not. So be careful. So the Bank of Canada, if you go to the Bank of Canada's website, they're mentioning that inflation in Canada remains high, but should come down somewhere to around 3% in the middle of the year because of lower energy prices. Well, wrong again. I do not agree with this at all. Why do I not agree with this? Is because if you go look at OPEC, they are very angry about this and they're putting oil cuts. Remember, these guys just cut 1.16 million barrels per day. And they're doing this because they want more money. Let me tell you this. If you know that oil over time, of course it fluctuates week by week, month by month, but if you know that oil is going to be more expensive next year, more expensive the year after, more expensive the year after that, the longer you can leave your oil in the ground, the more money you're going to make overall. You get my drift? So the countries are doing really good by leaving it in the ground. Guess that Saudi Arabia, their export is oil. It's not that it's their main export or one of the majority of exports. It is oil. It's a giant desert. They stick a straw under the sand and suck out oil, some of the cheapest production oil in the world. They are buying now Russian oil. Here's a country that only has oil, and they're buying oil from Russia because it's cheaper than what they can suck out of the ground. And they know that their money in the ground is worth more tomorrow. Genius move. If you think of it from a business standpoint, hurts us because oil is the backbone of the entire economy. So look at that. I can't believe it. It is not going to be standing. Now, I know that they say it's because of lower energy prices. Well, this is not going to stick around for long. As you saw, they're just cutting it. Bank of Canada as well, if you go onto their website and look into it, inflation in many countries is easing in the face of lower energy prices. Well, you guys just saw that though they're looking backwards in time to make this statement, we're looking at current things right now. So keep checking this channel to make sure that you're up to date with current events. It says that recent stress in the banking sector has tightened credit conditions further. Please understand what tightened credit situations are. Last year, we were seeing commercial banks lending against commercial properties 80%. 80%. So if you had $1 million property, they would lend you 80%, $800,000 mortgage. Now we're seeing 55%. They want you to put 45% down on a property. Same thing is happening in residential properties where they want to put huge amounts down. That's tightening of financial conditions, meaning we are not going to be lending to just anybody for any reason. You have to be creme de la creme as far as jobs and goods and services. Look at this. Supply and labor market remains tight. So there's too many buyers out there for properties, too many buyers for goods, and too many jobs out there. More and more trouble. If we look at the monetary policy report at the press conference, you can go and read this as well. Now look at this. This goes to a main principle. We would call this a Davidism. The cost of the things that you need to survive. Notice I'm saying the word need, underline, highlight, exclamation mark. The things that you need to survive go up. The things that you want go down. High expensive properties are dropping in price drastically, but the bread and butter type housing is going up like crazy. Also, food, energy, the things that you need to survive are going up. Food price inflation is still above 10%. Now, they're going to say to us, for sure, services price inflation remains high, expected to decline gradually. All of this saying, well, maybe we'll have more production, maybe we'll have lower costs of distribution. I don't believe that. The reason why I don't believe that is I've never seen it. Every time that prices hit a new plateau, they stay there. They don't usually come off. This is not surprising. We knew that the Bank of Canada was going to pause rates. We know that the rest of the world is struggling with inflation. Remember, inflation is just a tax. It's an invisible tax that people don't really understand very well. If your paycheck has 30% removed for taxes, 40%, 50% in Canada, if you have a huge chunk taken away for taxes, imagine we said instead of 50%, it's going to be 70%. I'm telling you, there'd be revolts down the road, pitchforks. Okay, it would be crazy. But if they have 20% inflation, everyone is like, I don't know how this happened. It's like this mysterious fugazi that's taking place. They don't understand it. And so people don't get as riled up. And this is why for thousands of years, nobody ever gets riled up about inflation because they imagine that it's this imaginary thing, but it comes from money printing and too many things that are going on at the same time. We already know the unfunded liabilities of countries are very, very large. And so we have a lot of inflation that's going to be baked into the pie. So whether they report it or not, please refer to Shadow Stats. It's a very important website to teach you about how they measure inflation. And inflation is going to continue going up for a significant amount of time. So you have to brace for high inflation. Prepare for high inflation. I'm expecting 10% inflation minimum for the next 5 years. And so if you prepare for it, and it doesn't happen, you're going to be golden. If you prepare for it and it does happen like I think it will, then you're going to be prepared and ready to make a lot of money. Remember, inflation doesn't remove money from the system. It just relocates it from one person's pocket to the other. So I want you to learn about financial education and learn how to use that to your benefit. If you have assets that produce good cash flow, they will be erasing your debt with inflation. This is the same trick that the governments have used for hundreds of years by using inflation to reduce their national debts. We did it. The United States did it, 1945 to 1950. This is what they did. And so this is going to be what is going to happen next. This is not a 1970 demand issue that we run into when everyone talks about inflation. This is rebalancing the global GDP that happened in 45 to 50 to pay for the war efforts. So please, please, please study some history if you want, or if you want the easy way, just tune into this channel. Please hit that notification bell, like this video, and subscribe to it. I hope that I've helped you out a lot. I want you to be super successful. Remember, next 2 years is going to dictate the next 20 years of your life. I'm here for you guys. I hope that you have a fantastic day.